Hey everyone, Daily Juice Anna, and I am on the streets of Washington, D.C. So I'm heading out. Here's the office I work at. You see that? All the way on 11th floor, right up there. So I'm just, it's not Morgan Stanley though, right? Anyway, I wanted to hop on and just kind of say hello to you. And something that was on my mind, even though today was another worst day in the stock market, honestly, it's kind of interesting that I have not gotten a single email or phone call from one of my clients asking what to do, what's going on. So that's something to discuss for the next session. But you know what I was thinking? I was thinking about what happens, because I got this question quite a bit in the last few days. What happens with our savings accounts, our mortgages, our debts, because we recently had an interest rate increase. And so one of the things that I want you to consider that, and there's two points here, right? So there is the fact that our savings accounts are getting more return, right? I'm going to try to find a good spot for getting the light in. So the savings accounts are getting higher returns, right? Because the interest rates have gone up. Now, and that's good, right? We like that. So the latest online savings accounts are paying about 1.8%. Now, what happens, hi Andy, good to have you here. What happens with the debt? This is where we kind of get in trouble, because increase in interest rates does not positively affect the debt that you have. Now, if you have debt that has fixed rates, sure, but what about debt that's that variable? So things like student loans, I had clients with variable rates on student loans, right? It's already a huge burden for clients to pay that back, right? And anybody out there. But what happens when the rates go up? So you need to start thinking in terms of what can you fix? How can you make sure that those interest rates are fixed? So perhaps refinancing is something you can take into account. Now, this also applies to mortgages, right, as well as home equity line of credits. Do you have, and this is traditionally what happened over the last 5 to 7 years, because the rates have been low, and I expect you to have, to take advantage of loans that had variable rates because they were low. Now, it is time to think about whether you need to fix those rates, okay? So I want you to think about long-term strategy. Will the rates going to be low again? I don't know. Probably not what we've had before. But 4.5%, and this is about what I've heard lately, is the average rate on mortgages. So is 4.5% a good rate? Probably. Do you want to fix it? You should, especially if you have. Oh my gosh! Look at the sun. Especially if you have rates that are higher. So consider reviewing. What do you have? Do you have a savings account that perhaps needs a boost? But do you have debts that could benefit from having the rates be fixed, if it's all possible? I hope you found this useful. You have a fantastic weekend, and check out the streets of Washington, D.C. Just actually 2 days later, not even 2 days, after we had a big snowstorm. So I will see you soon, and let me know if you have any questions. Bye.